Hello and welcome back to the Microlearning Institute. In this tutorial we look again at IFRS 2 share-based payments, and here we specifically look at how to account for a share-based grant with a performance condition in which the exercise price varies. Remember again that the formula for calculating the cumulative equity to the statement of financial position in relation to IFRS 2 share-based payment is given from the estimated number of employees who are entitled to the share-based payment multiplied by the number of instruments per employee multiplied by the fair value of the instrument at grant date, and that number is time apportioned over the expected vesting period, with a corresponding movement being taken to the P&L. In this example, we're told that at the beginning of year 1, an entity grants to a senior executive 10,000 share options, conditional upon the executives remaining in the entity's employ until the end of year 3. The exercise price is $40. However, the exercise price drops to $30 if the entity's earnings increase by at least an average of 10% per year over the 3-year period. On grant date, the entity estimates that the fair value of the share options with an exercise price of $30 is $16 per option. However, if the exercise price is $40, the entity estimates that the share options have a fair value of $12 per option. So again, we can simply tabulate the differences here. If the earnings improvement is less than 10%, then the executive is entitled to exercise at $40, and we estimate that the fair value at grant date of that transaction is $12. However, in contrast, if the earnings improvement is more than 10%, then the executive is allowed to exercise at $30, and we, the entity, estimate that the fair value of that transaction at grant date is $16. First, we're told that during year 1, the entity's earnings increased by 12%, and the entity expects that earnings will continue to increase at this rate over the next 2 years. The entity therefore expects that the earnings target will be achieved, and hence the share options will have an exercise price of $30. So again, looking at our table, we see that 12% is in excess of 10%, that the executive will be allowed to exercise at $30, and consequently the fair value at grant date of that transaction is $16. Now we see how we account for this to our P&L and statement of financial position. We have one executive entitled to 10,000 options. The fair value at grant date is deemed to be $16, and the vesting period is 3 years. So we time apportion the equity over the vesting period by multiplying by 1/3. And of course we take a corresponding expense to the P&L. Next, we're told that during year 2, the entity's earnings increased by 13%, and the entity continues to expect that the earnings target will be achieved. So again, 13% once again is in excess of 10%, so consequently the exercise price will be $30, and consequently the fair value at grant date will be $16. So again, the cumulative equity year 2 is calculated from one executive, 10,000 options, $16 fair value at grant date, and now 2/3 of the equity must be recognized as a time apportioned. So we recognize cumulative equity now of $106,667, up from $53,333 in the previous year. So we need to recognize an incremental expense of $53,334 to the income statement. Next, we're told that during year 3, the entity's earnings increased by only 3%, and therefore the earnings target was not achieved. The executive completes 3 years service and therefore satisfies the service condition. Because the earnings target was not achieved, the 10,000 vested share options now have an exercise price of $40. So again, because our earnings target was not achieved, it was less than 10% overall, the exercise price now goes up to $40, and we now think that the fair value at grant date of that transaction is $12. So now let's see how we account for the cumulative equity to the statement of financial position. Once again, we have one executive entitled to 10,000 options. The fair value at grant date has now been revised downwards to $12, and again we recognize all of the equity because of course the vesting period has elapsed. So therefore, the cumulative equity to the statement of financial position is now $120,000, up from $106,667 last year. So we recognise an incremental expense in year 3 to the P&L of $13,333. Thank you very much for watching this short tutorial on IFRS 2 share-based payments from the Microlearning Institute.